Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. I'm your host, Jeremy Dyer, and I'm here by another amazing guest. Surprise, surprise. I have Brett Swarts. Brett, welcome to the show.
Jeremy, grateful to be here. Thank you so much for having me.
Absolutely. Looking forward to chopping it up with you. So listen to this, guys. Brett is the founder and CEO of Capital Gains Tax Solutions, where he helps entrepreneurs, investors, and high net worth individuals preserve and grow their wealth by legally deferring capital gains taxes. I can't think of anything more exciting to talk about today, Brett, than avoiding paying taxes. So before we really jump into the granular nitty gritty, maybe you can let our audience know a little bit more about, yourself, your background, your journey, what you're focused on today, et cetera.
Yeah, I think the Minnesotans who are listening to this can appreciate it. I grew up in Taxifornia. I think Minnesota is the most understood tax state. And Oregon's another one that's kind of hidden in there. Oregon, Minnesota, but of course, New York, New Jersey, Taxifornia, those are the massive tax states. So for any of the tax paying of owners of real estate or businesses, I think you're going to connect well with this. So I grew up mostly in the Bay Area building these houses with my parents. So I fell in love with real estate at a young age. I was the guy hammering the nails, driving the Bobcat, moving the bricks. My brother and I, it was kind of a childhood dream until it wasn't. My parents made all the wealth, and then they got divorced, unfortunately, and the wealth was split, and it was but mostly it was like on my dad's side, and he paid child support, right? So at a young age, I was like, you know what? I don't want wealth to crush the family. I want wealth to be a blessing to the family. And so why don't we go to college? My parents to my brother and I. So he's the first to graduate college ever. I was the second. And then we started to study and practice at a place called Marcus and Millichap, where we learned the investment side of real estate, brokering, underwriting, and fell in love with that. And this was 2006. And, that's right before something happened, right? 08. So 08 was like a wrecking ball financially for my wife and I and our first daughter. And we, moved to my brother's small condo, working side hustles at Cheesecake Factory. But all along, I felt like this calling to serve investment, or high net worth families, or just families that are trying to build, passive income, build wealth in real estate, because that's what I grew up doing with my family, right? So I wanted to help others do the same thing. And then along the way, we learned that they also lost a lot. In fact, most of them lost because they did these 1031 exchanges, which I'm sure your listeners know, and we can, of course, talk about. But they had overpaid for properties. The 1031 came up short for them. And I saw friends, family, and clients lose half or all their wealth. So we said, there's got to be a better way. And so I'll never forget, I'm at Marcus and Millichap. It's 2009. And we're learning about this strategy we're going to talk about today, which is an installment sale with a trust that's separate than a 1031, that is a game changer for people who want to exit businesses, Bitcoin, real estate without the time restrictions of the 1031. And I sat there going, wow, this is Netflix. And this is before Netflix was around. But I'm like, these people are stuck in Blockbuster. If everyone knew Netflix, why would they ever go back, right? And so that began my journey of studying and practicing this strategy of how it can apply to purpose-driven entrepreneurs and investors so that they can multiply their freedom and impact. Fast forward, wife and I have 5 kids. We live in Jacksonville, Florida now. We moved just 3 years ago. And we serve people across the country that are exiting, professional practices, dental practices, veterinarian practices, big tech companies, stock exits, Bitcoin exits. And it's all around this idea of that fourth quadrant, Jeremy, of Robert Kiyosaki's book, Rich Dad, Poor Dad, which most people never actually accomplish. They get stuck in quadrant 2 and quadrant 3. But we believe truly passive income is what quadrant 4 is. But most entrepreneurs and investors never get there because they're stuck being so active, and or the strategies they want to go into produce just nominal cash flow. And the way to get to truly passive income, we call that $40,000, $50,000, $60,000 per month. The fastest way we found is exiting something large, like a huge multi-million dollars of Bitcoin, business, real estate, and getting truly passive into stuff that's massively cash flowing, typically 8, 9, 10+% returns. And that's the game changer. That's the big domino that falls over. So we can go into all that I just talked about there.
Yeah, no, that makes sense. And I appreciate that background. You clearly have a knack and an interest, for this kind of tax deferred status or state. So would love for you to tell us a little bit more about, kind of the vernacular here. We talk about deferred sales trusts. We talk about Delaware Statutory Trusts. What's the difference between those, two DSTs? And then I want to throw in there, just from our listening audience that may not understand, what a 1031 exchange is. I've also heard the terms light or lazy 1031, traditional 1031. There's all these kind of different vernaculars that people throw around out there. And I'd love for you just to kind of bring us up to speed, maybe give us the 101.
Yes, absolutely. So we'll start with the Blockbuster methods, right? That includes lazy 1031, traditional 1031. That includes, reverse 1031. That includes the Delaware Statutory Trust. I like to say a Delaware 1031. Why? Because that's all in this tax code called IRC 1031. It's a tax code that most people know of, that you can trade investment-like real estate into other investment-like real estate as long as you follow certain rules, such as identify that property within 45 days, generally speaking, unless you're doing a reverse, and it's a whole nother kind of thing, and close on one or two of those, three of those properties, depending on which ones you do. So you're in this time constraint, and you're also in the asset constraint. Okay, it's only one asset class for another asset class. Now, here's the thing: I love real estate. I love an amazing 1031. I think it's the best way to create long-term risk-adjusted wealth. I love it, but I love it when I can buy it right. Where do you get crushed in real estate? When you buy wrong, right? Like people have in the last couple of years, and they overpaid. Interest rates are adjusting, and they're losing half or all of their wealth right now. It's happening. And I think actually the year of 2026 is the year of the jujitsu tap out for mostly multifamily folks who overpaid, and the interest rates have adjusted and the rents have kind of stagnated. And so that is something that's so crucial here. Quickly breaking down the Delaware. The Delaware is like a passive 1031, and like professional operators, you have no liquidity, no diversification, no control. Right? Which, if you think about that, like if I said, Jeremy, what is the perfect real estate investment? You wouldn't say no liquidity, no control, right? And marginal cash flow. You'd be like, that's the opposite. But this is what people at a certain point, they just throw their hands up and they're like, I'll want to just push the easy button. And by the way, these fees are huge. 10 to 15% of every dollar you're putting in is going towards these securities advisors that are taking these fees. The properties are beautiful, and they're, Class A, big old properties. And so, but for what? Like, is that really what you want? No, you want truly passive cash flow. I can tell you, I know, I've done this long enough. I really believe it's probably $30,000, $40,000, $50,000, $60,000 a month. Okay, so that's a Delaware, okay? But they do have their place, by the way. They're non-recourse debt, which is nice. You actually are passive. I mean, the money shows up and you don't have to do anything for it. So they have their place. The lazy 1031 is really not using 1031. It's actually using a cost seg bonus depreciation method where I don't even have to use a 1031. It's more like a Hollywood video. I do like it if and when you have either assets that you have existing that you're going to hold for at least 5 years, that you haven't done accelerated depreciation. Accelerated depreciation is basically taking like a multifamily deal that's 27 and a half years and compartmentalize these 7, 5, 3 years and even getting a big one in the first year, where I can take the depreciation, we call this tax flow, to offset a gain from another asset sale in the same calendar year. Something to be aware of there. I do like those. And we do use those for deals that are smaller, because we like to see $1 million net proceeds for ours and $1 million gain. So that's the lazy 1031. The traditional 1031 exchange is just really simple. You're selling your property and you're buying and managing the next property yourself. You're doing that in the 45-180. You're also having to replace the debt. Here's the biggest thing that crushes people in real estate. They don't have tax flow, cash flow, and debt flow mindset or strategy. They have cash flow. They call cash flow is king, and that's the one thing they focus on. They don't really have a strategy for tax flow or debt flow. And the thing in the middle of this that keeps it all together is timing. This is where the Deferred Sales Trust is a game changer, and why we call it Netflix, because it's the one strategy that allows you to get tax flow, debt flow, and cash flow while having time on your side, versus it being a constraint. Let me give you an example. We had a client, we did a $13 million car wash exit out of San Diego. This is a few years ago before interest rates went up. I would say 98% of the commercial real estate market knew this is probably the peak or close to it. We didn't know interest rates would do what they would do, but we knew like this is not a good time to buy. It's a great time to sell. Bonus depreciation, it was still 100% at that point. You had interest rates that were all-time lows. You had an insane amount of offers and deals going over price. Like it was pretty much, the writing was on the wall. Great time to sell, terrible time to buy. So what do? We sold, we paid off of their debt. This is key. We put them into a trust. This trust, it gave them a promissory note. Funds are sitting at Charles Schwab. We mainly went into real estate debt paying 10+% return. We went into some money market accounts paying about 4%. We actually went and diversified into some stocks, some hotel syndications that had got foreclosed on. They were buying some of these. So anyways, they were diversifying. And what happened? The market completely shifted over the next couple of years, and we're still kind of in the middle of it, right? And we're so happy, right? We're like, this is incredible. And they were actually passive. The best part about all of this is they are developers, right? They will go back in using the trust to buy more deals, but they're looking for them right now. In other words, we have found it takes at least 3 years from the bottom of a commercial real estate market to from the top to the bottom, right, for it to flip, and then vice versa to flip again. We believe this year and last year were kind of the bottom, right? We'll know for sure, looking back, but this is what we've been waiting for since interest rates have gone up, and so this is what we're doing. So as we have deals that are investments that are semi-liquid, I call it 30, 60, 90-day liquid and debt funds, and actual liquid, we're buying deals all tax deferred. Okay. And that's the piece people explode. They go, how are you doing that? That's not a 1031. It's like, we're not using a 1031. We're using an installment sale with the trust. So that's the broad overview. I know it's a big answer for people, and we can kind of dive in. The last thing I'll say is the Deferred Sales Trust works for Bitcoin, businesses, real estate, primary homes, whereas all the 1031s, they only work for investment real estate. They don't work for business exits. They don't work for primary home exits. They don't work for Bitcoin or stock, whereas the Deferred Sales Trust works for all of those, right? So that opens up the opportunity to help serve more people.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, you can go to our website and set up a call with our team.
Yeah, no, that makes sense. And I appreciate that. I'm going to just ask you some additional kind of clarifying questions based on what you just said. But before I do that, I did want to highlight, some prime examples, really, of what Brett's talking about here related to people desiring to go through the traditional 1031 exchange process for the reason of they want to defer capital gains tax consequences, but all too often they do that with the risk of maybe partnering or putting that capital with the wrong operator. They're not diversified enough. They're sticking all their eggs in one basket. They've overpaid, for that replacement, property. And I can tell you, I know hundreds of people that executed a 1031 exchange out of a multifamily real estate deal in 2021 and 2022, only to 1031 exchange into a dog deal where they lost all their money. So that first turn, they doubled their money in 18 to 24 months. That second turn, they lost it all, right? All because they wanted to kick that capital gains tax consequence down the road and defer, and hopefully die someday and have that step up in basis. So maybe you can kind of comment a little bit more, on that, and how a deferred sales trust really helps to solve for, diversification, ensuring that people don't overpay for assets.
Yeah, you're spot on, right? You have to ask yourself, and I think the answer would be what are you doing this for? Like, what matters to you the most? And they say, well, I want to create wealth. Okay, yeah, I want to create passive cash flow. Yes, passive cash flow. I want to be able to, maybe serve and create some housing for people. Great. These are all good things, but what matters to you the most, right? And most I have found for the investors and the clients we serve is the idea of truly passive income, right? It's not just passive income, because passive income, I think, is a lot of It's really a term that's thrown around too much in the real estate world. And it's not, it's a myth. It's a myth. If you own real estate, it doesn't matter if you have property management. It's not passive. There's tenant laws that are changing. There's rent control laws that are changing. There's evictions. There's insurance that's increasing. There's constant change, especially for these higher tax, more regulated states, that make it very painful. The opposite of passive is painful to be an owner, okay? Truly passive income we define as this. No shoes, no shirt, no problem. You're Kenny Chesney playing a guitar on the beach. You have your hat on, you have your glasses, you have your drink to the side. The ocean is lapping up and you don't have a care in the world, right? And the money is coming in to each month, $20, $30, $40, $50, $60,000 per month. And you're not trading any of your time and your energy or your stress for that. Okay, that's truly passive income. Now, here's the second thing. It's in something that's durable and you can count on. Like it's in real estate, but someone else is doing the thing. It's in real estate debt that you understand that someone else is running on that debt fund. It could also be in the stock market. It could also be in some other things but you don't have to do anything anymore for that. Okay, that's truly passive income. In fact, we believe that truly passive income is to your freedom and impact. It's compounding interest is to your money. And it's the big domino. If you knock over, the rest of the stuff either becomes irrelevant or it solves itself. And I'll bring it to life for a story. Warren and Catherine are clients of mine. They had two twin daughters a little bit later in life. At 10 years, they were 10 years old at the time when they came to me. Like, Brett, we have 8 years with our kids. Like, they're going to be off to college. Like, Warren and I want to spend more time traveling. We have a great property in Sacramento. It's worth a couple $1 million, but we have a great property manager, but it's always just something pulling us there. There's fires, there's insurance, there's the tenant that needs to be negotiated with. There's just something, and we've made the couple million and millions. We don't need any more millions. We only have so much time with them before they're 18. So what matters the most to them was these two twin daughters, but they had these other T's in the way: toilets, trash, termites, and their time being taken away, right? So we'd basically trade the 3 or 4 T's for the 2 T's. It's not a hard trade, right? It's don't trade what's priceless for what's profitable. The property was profitable. What the time with their kids were priceless, okay? But here's the cool thing with our strategy. You don't have to compromise. You can do the power of and here, right? I can help them. I help them sell, defer the tax, and actually increase their cash on cash return. In fact, we went from about $120,000 to about $190,000, okay? And we diversified their wealth, and they didn't have to take on any debt. And here's the best part. They got all this time back with their kids. That's priceless, right? And so it's really, really important to understand that you have a clear vision on what you're building and why you're building it for. And like start with the end in mind, right? What's the purpose? And I think truly passive income for most people is 98% of the time what the purpose is. Now, does that mean that you never do a 1031? Not at all. Like if you could find a deal that makes sense in the time constraints, we offer the best 1031 exit plan, which gives you the ability to save a failed 1031 with us. By the way, sometimes they're doing a half 1031, like we did with a client, a $6 million exit out of Texas, and a half deferred sales trust. Sometimes we're doing a third, a regular 1031, a Delaware 1031, and a deferred sales trust. So I also want to say to you that the deferred sales trust has some limitations. The limitations, sometimes we need to use other 1031s to accomplish some challenges, but it really delivers the most value for that truly passive income number. So I hope that answers the question, Jeremy, but let me know if you have any thoughts on that.
Yeah, no, I definitely do. And I appreciate that. So maybe walk us through a little bit more about this rescue, a failed 1031 exchanges. What typically goes wrong, and why is it that, the deferred sales trust, really acts as that kind of pressure release valve?
Yeah. So the number one thing that goes wrong is people can't find a quality deal within the time frame that's allowed it, right? So you have 45 days to identify them from the time you close and make sure your funds are with a qualified intermediary. And you go shopping, you go looking. So that's the first thing that goes wrong. You're not finding great deals. But even if you find a decent deal, here's the reality. Most the sellers are going to know you're in a 1031. First question they ask, like, who's the buyer? They're in a 1031, and they go, oh, great, that's an extra at least 10 or 15 or maybe 30% more, right? And brokers do the same thing. I'm a California real estate broker by trade. Like if you had a 1031 buyer, it's our probability just went up a 90% that we're going to get paid, right? So this whole world of a 1031 is completely disadvantaged, just like playing poker with your cards out, Jeremy, right? And they're like, just please let me buy your property, right? And then the inspection report comes back and you're like, oh my gosh, this thing's a dog. And they're like, sorry, or excuse me, Mr. Seller, your property has this mold and it's a dog, and I'm asking for $250,000 credit. And they're like, nope. Go pound sand and just buy the deal. And you're like, okay, thank you. May I have another? And you just buy it, right? Like that's kind of, unfortunately, what a lot of buyers have to go through. And so we have what's called the best 1031 exit plan, which is a pressure relief valve, exactly what you said, where you can walk in and you can say, hey, Mr. Seller, I would like to buy your deal. I am in a 1031. I'm a very probable buyer. I want a fair and equitable deal. But if you're not willing to do that, I'm going to let you know right up front that I can use a deferred sales trust with capital gains tax solutions, and I don't need to buy your deal, right? In fact, I might come back a year from now when your interest rates are finally adjusted, and I'm going to, maybe try to make a deal with you at 10 or 20 or 30% less. like this is what we do, right? We buy it based upon the cash flow. We let the cash flow, determine the price, and we don't let the tax flow inflate that price, right? And then, of course, the debt flow has to make sense. We have to make sure that we can get quality debt at a good interest rate, at a good term, so that our cash flow is not compromised to just lose the whole thing, like you were talking about before. So real simple. You work with us for the best 1031 plan. We have the QI company that we've already pre-set up the paperwork to give you this pressure release. Technically, we basically would de-identify by day 45 if you couldn't find anything. Day 46, we can go into our strategy. And our money's liquid, it's diversified, and it's ready to pounce on the next deal. Now, here's the cool thing. Let's say you find a perfect deal, day 130, and day 46, you went into our best 1031 plan and then went into a deferred sales trust on day 46. You would, let me back up. You go to our best 1031 plan before you exit, before you sell, right? So you're using us basically is to help you with the 1031. Day 46, you're into the deferred sales trust, but you find a deal the next day or a year from there, you can partner with the trust. And this is the best kept secret and probably the thing that really adds the most value to the entrepreneurs and investors we serve. You can joint venture partner. The trust can be that silent partner that invests alongside of you to go buy that deal. Let me give you an actual one that happened. We had a client, he sold a business out of Alabama. Notice he sold a business and wanted to get into real estate here. He deferred all of his tax. He used the funds in the trust to help him build investment real estate. All tax deferred, no timing restrictions, okay? Now he's selling those assets in Tennessee right now, and it's going back into the trust. All tax deferred, no timing restrictions. And so that's the big thing here. Like you don't have to be passive, but you can be. You can also be active, but you got to have a team and a plan in place.
So let's talk to that person that I hate to say this on my podcast, but let's talk to that person that says, holy shit, Brett, I wish I had known about this 6 months ago. I just had a massive exit. And I didn't know that this type of a, tax deferred, sales trust, was even an option. And quite frankly, it sounds too good to be true.
Yeah. So first of all, I would say, gosh, I'm really sorry. Okay. The government, it has about 40 trillion in debt, and we need some really, really courageous Americans to pay that down. Now, I'm so sorry you have to be one of those. I wish that we would have met us sooner. Okay. It's the first thing I would say. Second, if it's in the same calendar year, and I am truly sorry, this actually is the most painful conversation we have with people. You can't use the deferred sales trust if you weren't set up before you closed, either using the best 1031 plan with us or set up before you closed. Okay. So we do need to set up before the close of escrow, at least the best 1031 plan. Of course, if you're selling a business or primary home or Bitcoin or stock, you need to set up before you do anything else before that. Okay. So get with us early. Okay. It's the first thing I would say for your next exit. If you're within the same calendar year, you can look at opportunity zones. Okay. If you're in the same calendar, you can look at the lazy 1031 or just buying and getting some cost seg bonus depreciation. So you still have some opportunities there. So I'm sorry. Now back to the objections piece, right? There's really three major objections I'm going to work through right now with people, right? The first one is what you just said. Hey, this sounds too good to be true. Like, gosh, man, I'm Jeremy Dyer. Like I've been doing this for 25 years. Like I've, billions and, hundreds of millions. And like how I haven't heard about this. Like, and by the way, I was there, Jeremy. I was sitting at Marcus and Millichap in 2009 being like, dude, this guy's talking about Netflix. We're all on Blockbuster. Like, is this really real? Right? Let me give you the quick track record. Okay. Thousands of transactions closed at this point, close to 30 years and over 30 no change IRS audits. Okay. Billions of assets sold using this. All 50 states, but every asset you can imagine. Okay. We recently did a $70 million exit out of a Northeast or business tech sale. I already told you about the $13 million in San Diego. We did $8 million up in Massachusetts. We've done, another $8 million in Santa Cruz, another $8 million in Palo Alto, primary home, investment real estate, large $40 million plus exit out of the West of a business sale here recently. So we have the track record. And I would also tell you that there's lifetime audit defense built in. Okay. And there's about a 2 to 3 year audit window on most states, 4 years for like California. That's like the audit window. We're not really concerned. We have audits. We have no changes, but it's not anything that's remarkable in the sense of how you report it with your CPA. You're just reporting an installment sale on most transactions. And it's like, if you did a seller carryback, Jeremy, for a deal you own in Minnesota tomorrow, would you be concerned that it's an installment sale? No, you'd be like, hey, CPA, I did an installment sale. I'm paying tax on what I receive, and the rest of it, I'm in a deferral state. And here's how we report it. It's actually very simple, but there are those out there that don't want you to believe it's true. In fact, the 1031 exchange accommodators and some commercial real estate brokers. Why? Well, how do they get paid? They get paid with a 1031. Now, I say that because that's where I'm a broker. I've done 1031s, right? So, okay, so that's the legal part. So put that to the side for a second. The second major objection is the trustee. Like there does need to be a third party unrelated trustee. That's what we do as our service is capital gains tax solutions. We're a trustee company. So we're kind of like a 1031 exchange company. We're kind of like an IRA or 401k company. We're kind of like that, right? We're that third party unrelated trustee that serves. And so, Jeremy, you do, or the listener does have to give up some control, right? Because if they just sold it to themselves, it'd be taxable, but they sold it to the trust in exchange for a promissory note, they become the creditor. That's how we can defer the tax until they receive payment. However, these are single entity trusts that only do business with the person who's selling, and if they're married, their spouse. And funds never move without their approval or their signature. Funds are held at like places like Charles Schwab. We have professional financial advisors. Clients go back and do their own deals, kind of like the self-directed IRA. We have clients that go into private equity, private debt deals. We diversify. And so honestly, like the trustee is kind of like the quarterback or the offensive coordinator, making sure everything's executed. But there's lots of diversification with the transparency and the accountability and who's actually running the investments. Okay, so that should help people there. There's also a third-party tax preparer that does all of the profit and loss statements, all of that. Okay, so that's the controls. Last one is fees. Okay, so it is more expensive than a 1031 because the 1031 is a commodity, right? And we're really a highly specialized service. So there's about a 1.5% of the first million is the legal fee. So like on $1 million deal, it'd be like $15,000 to the legal fee. On $1 million that we have under trusteeship, we're charging collectively with the financial advisor like 1.5% to 2%. Okay, now we like to cash flow those fees, meaning we get the funds invested, hopefully go make some cash flow, and then wait a little bit and start getting those collected. And so we're not dipping into the principal. So the ROI is important here. We like to see $1 million net proceeds, $1 million gain, no matter what state you're in, as long as you can live off the cash flow of 6, 7, 8, 9, 10% over a period of time. You have an extra 30 or 40% of proceeds working for you. That's a great ROI we have found. Okay, so those are the three: legality, control, fees. Once you understand how it works, who we are, our client testimonials, we do have a very high close ratio from what we've been able to do, but we invite everyone to come get to know us and see if it's a good fit.
Yeah, that makes sense. And I appreciate you unpacking some of those kind of objections and risk factors that most investors think about. We did also cover those folks that waited too long to make some decisions and kind of plan for the future. But I'd like to, as we kind of wrap up here, I'd like to talk about that person that's more proactive. They know they've got a transaction event, coming up in the next, months or years. What can that person be doing, today to take action so that they're best prepared for when they have that future liquidity event?
Yeah. So the first thing I would say is you spent, maybe 10,000 hours building your business, your real estate, your Bitcoin empire, whatever it is, studying and practicing it, being disciplined. And we would say you just spend 5 hours with us to build a capital gains tax exit plan, and you can have an extra 20 to 50% of the proceeds. So like, first of all, just knowing what's at stake, if you do not do the planning, is up, as high as half of your proceeds are going to be crushed by tax. We've seen recently, obviously, the government is not very efficient, nor are they very honest a lot of times with the way they spend our tax dollars. I'll leave it at that. And but it's painful to think about the opposite of if it's not planning. And so the good news is with us is we work on a conditional basis, Jeremy, right? So we sit down, no cost, no obligation. We will build a trust, build the team, build the plan. For some reason, your deal doesn't work out. You end up not wanting to use our services. You owe us zero, okay? You can still sell your deal. You pay your tax or whatever. Go do a 1031, no problem, right? So we promise to never talk you into anything. If it's not a good fit, we'll let you know. We'll be the first to tell you that's not a good fit. We'll also tell you if we think it's a great fit, and we'll encourage you to take action. But the step is really to set up a consultation call with our team. Obviously have some key facts like what's the sales price, adjusted basis, what's the debt on the asset, what's the timing of the asset, what entity owns it, S Corp, C Corp, LLC, is it a partnership? Those are some general facts. And with that, we can start to build out what your tax pain or problem is and what solutions we can offer for this. But it's never too early. It can definitely be too late. Come, get on our mailing list, get our book, building a capital gains tax exit plan. Kevin Harrington from Shark Tank's in the book, on Amazon. That's it. I would just say get educated and get with us, and then we're happy to see if it's a good fit.
Yep, that makes sense. Well, the action takers dominate, the industry. So as an investor, be an action taker. And so I appreciate your perspective there. Brett, what would be maybe one or two different ways, outside of grabbing a copy of your book, what might be a couple of different ways that our listening audience can connect with you offline to learn more about what you're up to?
Yeah. So if you want to follow my wife and I and our 5 kids in our travels, we went to Uganda last year. We're going to New Zealand this year. We just Pebble Beach in California and DC. So we do some cool travels as we homeschool our kids. So just if you want to get to know me personally, like Instagram is a good way for that, or Facebook. And then like more professionally, LinkedIn, is a great place too. We're producing a lot of content. We have our YouTube channels and also have a couple podcasts. So we have 2 podcasts, the Capital Gains Tax Solutions podcast and the Build It to Billions podcast. Big secret, it's one interview that we kind of reproduce on both shows. And so it's we just have expanded the reach there. So yeah, you can check out those podcasts. I've interviewed 300 plus people like Jeremy that are incredible folks to interview. That's it. Those are the main places.
Cool. Well, we'll definitely put those links in the show notes for the episode. And Brett, I really appreciate you bringing us a tremendous amount of value today.
Grateful to be here. Thanks, Jeremy.
And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.